One Tesla income fund advertises a 248% distribution yield. The other advertises 81%. If your eyes immediately crowned the 248% fund champion, put down the trophy. Since launch, the first fund's net asset value fell 88%, while the second fell 22%. Add the cash distributions back, and the fund with the smaller headline yield produced the stronger, simple, distribution-inclusive result. That is the trap we are dissecting today. These are not ordinary dividend funds collecting profits from a portfolio of established businesses. Both are actively managed options machines built around Tesla. They use treasury collateral, derivatives, and leverage to turn Tesla's violent price movement into weekly cash distributions. But they build those machines differently, and the difference between a spectacular payout and a successful investment can be enormous. This is TSYY versus TSII, two funds staring at the same famously volatile stock, harvesting income through different option structures and producing radically different journeys for shareholders. We are going inside the machinery, separating cash paid from value created, and asking the only question a giant yield cannot answer by itself. After the smoke, noise, and weekly deposits, what did the investor actually keep? In the first corner is the Granite Shares Yield Boost TSLA ETF, ticker TSYY, issued by Granite Shares. It launched on December 18, 2024, has $85 million in assets under management, and charges a 1% expense ratio. TSYY is designed to seek current income while also pursuing daily 2x exposure to Tesla's price performance. That daily part matters. The target is not simply twice Tesla's long-term return. Daily leveraged exposure resets as the path unfolds, so the sequence of Tesla's gains and losses can materially affect the result. A smooth climb, a smooth decline, and a frantic zigzag can leave very different fingerprints even if they eventually arrive near the same destination. Under the hood, TSYY's listed holdings are United States Treasury bills at 88%, US dollars at 12%, and cash equivalents at 1%. It also writes 6 put options for premium income and holds other ETFs that pursue leveraged Tesla exposure. In plain English, most of the visible portfolio resembles a collateral warehouse rather than a traditional stock portfolio. The Treasury bills and cash help support the derivative positions. The leveraged exposure is the engine trying to amplify Tesla's daily movement, while the written puts are the toll booths collecting option premium. Writing a put means accepting an obligation connected to Tesla's downside in exchange for cash upfront. If the trade behaves favorably, the fund keeps the premium. If Tesla falls hard enough, that obligation can become expensive. Add daily leverage, and TSYY is not merely selling income against a calm asset. It is collecting premiums while operating close to one of the market's more energetic electrical panels. In the other corner is the REX Tesla Growth and Income ETF, ticker TSII, issued by REX. It launched on June 4, 2025, has $42 million in assets under management, and charges a 2% expense ratio. TSII seeks weekly distributions through a synthetic covered call strategy on Tesla while aiming for 105% to 150% of Tesla's daily share price performance. Its listed holdings are United States Treasury bills at 101%, cash offset at 0.69%, and US dollars at 0.9%. Its options inventory includes 2 call options and 1 put option written for premium income. The strategy uses both standardized exchange-traded options and customizable flex options, with US Treasuries serving as collateral. Synthetic is the important word. TSII does not need to build its Tesla exposure by simply placing Tesla shares in a vault. It can use combinations of options to imitate the economic behavior it wants. The call side participates in Tesla-related movement and helps create the covered call structure. The written option side brings in premium. The Treasury collateral sits behind those contracts. A covered call strategy effectively exchanges some potential upside for income today. If Tesla surges, the option structure can limit how much of that rally reaches the fund. If Tesla stalls, churns, or rises more moderately, collected premium may be useful. If Tesla collapses, however, premium is padding, not a force field, so this is not 2 labels on the same bottle. TSYY combines written puts with other leveraged Tesla funds and seeks daily 2x performance. TSII uses a synthetic covered call structure and targets a lower range of daily Tesla participation. TSYY is the more aggressive leverage and premium machine. TSII is still leveraged and still derivative heavy, but its design puts more emphasis on balancing growth participation with option income. The expense comparison also contains a twist. TSYY's 1% expense ratio is lower than TSII's 2%, but neither fee explains the large difference in their outcomes. With products like these, the behavior of Tesla, the leverage target, the option positions, volatility, and the path of daily returns can overwhelm a modest fee advantage. Cost matters, but architecture matters more. Before we continue, this is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold TSYY, TSII, Tesla, or any other security. ETFs can lose value, and leveraged and options-based ETFs can behave very differently from the underlying stock or from what a headline distribution yield appears to promise. Distribution amounts can change, and distributions may come from option income, gains, return of capital, or other sources described in the fund's documents. Verify the current prospectus, holdings, distribution history, tax information, and other official fund documents for yourself. Those details can change after this recording. Consider consulting a qualified financial, tax, or legal professional who can evaluate your circumstances before making any decision. Now we reach the numbers designed to dominate the advertisement. TSYY reports a 248% headline distribution yield and pays weekly. TSII reports 81% and also pays weekly. On the surface, TSYY's number is dramatically higher. But a distribution yield is a measurement of cash flow relative to a reference price. It is not a promise that an investor will earn that percentage, and it is not proof that the fund generated that amount as durable economic profit. A fund can distribute a great deal of cash while its underlying value falls. That is similar to receiving generous withdrawals from an account without first checking whether the account balance is shrinking. The money landing in your hand is real. The assumption that all of it represents newly created wealth may not be. The distribution histories reveal more than the billboards. TSYY's first 4 distributions averaged 974 cents per share. Its latest 4 averaged just 22 cents. That is not a minor trim around the edges. It is a transformation in the amount of weekly cash produced per share. TSII's first 4 distributions averaged 26 cents, and its latest 4 averaged 21 cents. Its payments also declined, but the change was far narrower. The recent averages are now almost neighbors, even though the quoted yields remain far apart. That contrast tells us why current distribution yield needs context. TSYY began with exceptionally large per-share payments, but those early amounts were attached to a much higher share value and a younger strategy. As the fund's value and option environment changed, the weekly payment per share compressed sharply. A historical or annualized yield calculation can preserve the visual drama of earlier distributions even when the current check is much smaller. TSII's payment record is less theatrical. It started at a lower level and recently remained relatively close to that starting pace. That does not make the payout guaranteed or economically free. It simply means the supplied distribution series shows less deterioration in the weekly amount per share. The mechanics also influence what can be paid. TSYY's written puts collect richer premiums when expected Tesla volatility is high, but taking in a large premium means accepting a meaningful contingent obligation. TSII's synthetic covered call structure also monetizes volatility, but some of the bargain is surrendering part of a strong rally through the option overlay. In either case, the premium is compensation for risk being transferred to the fund. It does not materialize because the options market forgot how to count. Investors should also distinguish payment frequency from payment quality. Weekly distributions can be convenient for someone who values frequent cash flow. They can also make a strategy feel more productive because the account receives constant activity. But 52 envelopes do not automatically contain more wealth than 12 envelopes. The source, stability, and effect of those payments matter more than the delivery schedule. On the supplied figures, TSYY wins the headline yield contest. TSII shows the steadier recent per-share distribution trend. Those are different victories. One measures the size of an advertised rate, the other describes how consistently the actual weekly amount has held up over the periods provided. Now let us examine what happened to the capital base underneath those payments. TSYY's launch reference price was $192.59. Its latest NAV is $22.33, producing an 88% NAV loss since inception. TSII began from a launch reference price of $20.49 and has a latest NAV of $15.92, for 22% NAV loss since inception. NAV, or net asset value, is the per-share value of the fund's underlying portfolio after accounting for its assets and liabilities. It is the foundation from which future returns and future distributions must be produced. When that foundation contracts, a high quoted payout can become less impressive because the machine is working with a much smaller economic base. TSYY's path shows severe capital destruction. Its combination of leveraged daily Tesla exposure, derivative obligations, and distributions did not preserve the original per-share value during the measured period. Daily leverage can be especially punishing when the underlying asset repeatedly moves up and down. A loss requires a larger subsequent percentage gain merely to recover, and repeated resets can turn volatility itself into a source of decay. The important point is not that leverage always fails. If the underlying moves strongly and persistently in the favorable direction, leverage can magnify gains. The problem is that Tesla does not owe the strategy a smooth path. Sharp reversals can force the fund to keep recalculating from a changed base, while option positions add their own wins, losses, timing effects, and upside constraints. TSII also lost NAV, so this is not a story in which one structure preserved every dollar while the other malfunctioned. Its synthetic exposure and income overlay still left shareholders with less per-share fund value than at launch. The difference is magnitude. A 22% decline leaves substantially more of the starting base intact than an 88% decline. There is also a practical recovery issue. After a modest decline, the remaining capital still has meaningful weight. After a severe decline, the fund has far less value per share available to participate in future gains or support distributions. A lower share price does not make the economic damage disappear. It records how much ground must be regained. Corporate actions, such as future reverse splits, could change the displayed number of shares and price per share without restoring lost wealth. What matters is the investor's proportional value before and after the adjustment. Cosmetic changes can tidy the dashboard, they cannot reverse the history. On the supplied NAV paths, TSII held up materially better. TSYY's larger headline income came with far heavier damage to the capital base. That is the central conflict in ultra-high-yield products. The payout can look like a roaring river while the reservoir behind it is draining. NAV alone is not the whole result because both funds distributed cash. To make a fairer comparison, we need to put the cash back beside the remaining fund value. TSYY paid $130.16 per share in cash distributions since launch. Using the supplied launch reference price, latest NAV, and distributions, its simple distribution-inclusive return is a 21% loss. TSII paid $14 per share since launch. Its simple distribution-inclusive return is a 46% gain. This is where the matchup reverses the impression created by the headline yields. TSYY delivered much more cash per original share, but the remaining value fell so dramatically that the distributions did not fully repair the damage. The shareholder received a substantial stream of money and still finished below the supplied starting reference on this simple measurement. TSII paid far less cash per share, yet the combination of that cash and its better preserved NAV produced the stronger all-in result. It is the smaller cash machine with the better measured finish. That distinction is crucial for anyone using income rather than merely admiring it. Suppose an investor spends every distribution. The cash may genuinely support living expenses, but the ending account value determines how much financial capacity remains. Suppose instead the investor reinvests. The outcome will depend on the timing and price of each reinvestment, which this simple calculation does not model. Taxes, brokerage circumstances, and individual purchase dates can also change a real investor's experience. The simple distribution-inclusive figures are therefore useful comparison tools, not individualized account statements. They answer a clean question. If we combine the stated cash paid per share with the latest remaining NAV and compare that with the launch reference, which machine created the stronger basic package? On that test, TSII is ahead. The result also demonstrates why cash received and return earned are not interchangeable phrases. A distribution moves value from the fund to the shareholder. Whether the overall pie grew depends on what happened to both pieces. There is a time period limitation too. The funds launched on different dates, so TSYY has the longer operating history in the supplied data. TSII's 46% result covers its own shorter life, not the same calendar window as TSYY's 21% loss. We should not pretend this is a perfectly synchronized laboratory experiment. Even with that limitation, these are the actual since-launch figures provided for each fund. They show that the highest advertised yield did not produce the highest simple distribution-inclusive return. The cash register was louder at TSYY, but TSII left the stronger receipt. Risk is where the personalities of these two strategies become unmistakable. TSYY's maximum drawdown was 89%. TSII's was 47%. Both are substantial. Neither belongs in a conversation about stable principal merely because Treasury bills appear prominently in the holdings list. The Treasuries are collateral inside derivative strategies. They do not transform the entire fund into a conventional Treasury fund. The economic exposure comes from the options and leveraged Tesla positioning layered around that collateral. Looking only at the visible Treasury percentage would be like inspecting a race car seatbelt and concluding that the vehicle must travel slowly. TSYY's deeper drawdown is consistent with its more aggressive design. It seeks daily 2 times Tesla performance, uses other leveraged exposure ETFs, and writes puts. That creates several interacting hazards: amplified adverse movement, unfavorable return sequencing, option losses, and the possibility that collected premiums prove small relative to a major Tesla decline. TSII's drawdown was much smaller by comparison, but 47% can still be financially and emotionally brutal. Its target of 105% to 150% of Tesla's daily movement means it is not a low-volatility substitute for a bond fund. Its synthetic covered call design can face downside from Tesla-related exposure while also sacrificing some participation during a powerful rebound. That creates different forms of frustration. TSYY can punish an investor through extreme capital swings and rapid erosion. TSII can punish an investor by falling with Tesla and then capturing less of an explosive recovery because the call structure exchanged some upside for premium. One machine risks overamplifying a rough path. The other risks being present for much of the pain, but only part of the celebration. The changing distribution profiles add another layer of risk. TSYY's payment history shows that an extraordinary initial cash rate can shrink dramatically. TSII's series has been steadier, but it has not been perfectly fixed. Anyone planning expenses around either weekly payment should treat the amount as variable, not as a salary contract. Tesla concentration is another shared vulnerability. Neither fund offers broad business diversification. Both revolve around the behavior and options market of one company. Changes in Tesla's share price, implied volatility, investor sentiment, and option pricing can affect the strategies at the same time. A fund wrapper provides tradability and operational structure. It does not remove single company concentration from the economic proposition. There is also strategy complexity. Standardized options have familiar contract terms, while flex options allow customized features. Customization can help a manager construct the desired exposure, but it also means a casual investor cannot understand the portfolio by glancing at a list of common stocks. These funds demand attention to prospectuses, holdings files, distribution notices, and strategy updates. Liquidity and scale deserve monitoring as well. TSYY's $85 million in assets is larger than TSII's $42 million, but assets under management alone does not settle trading quality or long-term viability. Bid and ask spreads, trading volume, market conditions, and the issuer's management decisions can all matter. The supplied assets under management figures are snapshots, not guarantees. The risk verdict is therefore comparative, not comforting. TSII experienced the shallower drawdown and displayed the more stable distribution trend. TSYY offered the more aggressive exposure and the more dramatic early cash flow, but shareholders absorbed a much harsher decline. Both remain concentrated, leveraged, options-dependent products whose outcomes can diverge sharply from simply owning Tesla. TSYY and TSII are different tools built from the same volatile raw material. TSYY is the high-octane design. Its lower expense ratio, larger assets under management, daily 2x objective, leveraged exposure holdings, and written puts create the possibility of dramatic cash generation and amplified participation. The supplied history also shows what happens when that aggression collides with an unfavorable path. The biggest headline yield came with the weakest capital preservation and the poorer simple all-in result. TSII is the more restrained of the two, not a restrained investment in absolute terms. Its synthetic covered call structure seeks a balance between weekly income and leveraged Tesla participation. In the period supplied, that balance produced less spectacular advertised income, but a stronger combination of distributions and remaining NAV. The choice between structures therefore depends on the research goal, not on which percentage looks best in a thumbnail. Someone studying maximum current cash flow would examine TSYY's premium engine, payment variability, and ability to survive NAV damage. Someone studying a blend of Tesla-related growth and income would examine TSII's upside limits, derivative construction, and behavior across different market paths. Someone prioritizing stable principle might conclude that neither machine was designed for that job. The decisive lesson is broader than these two tickers. A distribution is only one movement of money. It does not tell you whether the strategy increased wealth, returned part of the investor's own capital, transferred upside to an option buyer, or accepted downside risk that had not yet arrived. To understand an income ETF, follow the entire circuit: collateral, derivatives, leverage, distributions, remaining NAV, and total result. So do not ask only, how much does it pay? Ask, what risk is the fund selling to produce that payment, how much capital survived, and what did the shareholder keep after counting both cash and remaining value? TSYY and TSII offer different versions of the Tesla income trade. Neither is an automatic winner for every investor, and this comparison is not telling anyone which to buy, sell, or hold. Different tools fit different goals, and sometimes the correct tool is neither one. Verify the current fund documents, evaluate the full mechanism, and treat this entire autopsy as research and education only. 2 quick things before you go. If this head-to-head helped you cut through the hype, hit the like button and subscribe. It is what keeps these autopsies coming. And tell us in the comments, which of these 2 would you pick and what matchup should we run next? We read everyone. Thanks for watching.